Imagine your wealth is a bucket of water. You have been told that to fill it, you just need to keep pouring in small amounts of capital through a convenient, shiny app on your phone. But here is the part nobody mentions. The app is not the bucket. The app is a drill. Every time you open it, a tiny hole is bored into the bottom. Every time you trade, the drill spins faster. By the time you reach retirement age, you might find that you have spent decades pouring water into a sieve. We have been sold a story about the democratization of finance, a utopian narrative where anyone with $5 and a smartphone can become the next market titan. But in reality, the most popular trading platforms in the world are not designed to build your wealth. They are designed to facilitate your churn. If you think commission-free means cost-free, you have already fallen for the first trap. Today, we are going to look at the cold, hard math of why your brokerage wants you to be active, why they need you to be impulsive, and how the very colours on your screen are being used to pick your pocket. This is not just a rant about an app. It is a breakdown of a system designed to transfer your wealth to high-frequency traders while you are distracted by digital confetti. Before we dive into the neuroscience and the tax traps, I want to make a deal with you. The next 20 minutes are likely the highest return on investment you will see all year. We are going to strip back the UI and look at the underlying plumbing of the retail investing world. If you find this breakdown helpful, hitting the subscribe button is the easiest way to ensure you stay on the right side of the math. I spend my time digging through SEC filings and behavioural reports so you do not have to, and having you as part of the community helps me keep these deep dives independent and data-driven. I have noticed that the people who succeed in the long run are the ones who understand the mechanics of the game they are playing. Most people are playing a game they do not even realise is rigged. By the end of this video, you will have a clear blueprint for how to opt out of the casino and start actually building the kind of boring, massive wealth that lasts for generations. Let us start by following the money. Because in finance, if you are not paying for the product, you are the product being sold. The common belief is that the revolution of 2013 was a gift to the little guy. Before Robinhood, if you wanted to buy a stock, you paid a $7 or $10 commission. This was a massive barrier for someone who only had $50 to invest. When that fee went to zero, it felt like the gates of the kingdom had been thrown open. We were told that the brokerages were finally on our side, cutting their own profits to help us grow ours. But here is the first major myth. Brokerages are not charities. They are corporations with shareholders, and they are more profitable now than they were back when they charged commissions. If they are not taking a $10 cut from you, they have to be getting it from somewhere else. They found a much more lucrative way to monetize your behavior, and it is called payment for order flow, or PFOF. When you hit the buy button on your phone, your order does not go straight to the floor of the stock exchange. It gets bundled up and sold to a third party. To the average person, this seems like a back-office technicality that does not matter. But in the world of finance, whoever is closest to the order flow is the one who makes the real money. You are no longer the customer, you are the raw material for a much larger machine. Let us run the hard numbers on how this works. When you buy a share of a big tech company, there is a bid price and an ask price. The bid is what people are willing to pay, and the ask is what people are willing to sell for. The tiny difference between them is the spread. Large market makers, the firms that actually execute your trades, live and breathe in that spread. They pay your brokerage a fraction of a cent per share for the right to handle your trade. Now, a fraction of a cent sounds like nothing. But when you have millions of users making millions of trades every day, those fractions of a penny turn into billions of dollars. Here is where the math turns against you. Because the brokerage gets paid per trade, their entire revenue model is built on volume. If you buy a low-cost index fund and hold it for 20 years, The brokerage makes virtually $0 from you. You are a terrible customer. But if you trade 5 times a day, chasing every trend and jumping in and out of positions, you are a goldmine. This creates a massive, fundamental conflict of interest. Your financial health depends on you doing as little as possible. The brokerage's financial health depends on you doing as much as possible. They have a multi-billion-dollar incentive to make sure you never just sit still. This conflict of interest is where the psychology gets messy. We know from decades of academic research that the more frequently a retail investor trades, the worse their returns tend to be. A famous study by Barber and Odeon showed that the most active traders underperformed the market by a staggering margin. They found that humans are naturally bad at timing the market, and the friction of constantly moving money around eats into the principal. The brokerage knows this math. They have the data on every single user. They can see that their most profitable users for the company are the ones who are losing the most money for themselves. This is the dark side of the user experience. If a tool is designed to make you do something that is mathematically proven to harm your wealth, is it really a financial tool? Or is it an extraction device? We have reached a point where the interface of your investing app is actively working against your long-term goals. They need to keep you engaged, not because engagement makes you a better investor, but because engagement is the only way they can keep their lights on. This is why the app feels less like a bank and more like a social media feed. It is a feedback loop designed to keep the dopamine flowing and the trades clicking. So what is the protocol here? How do you win a game where the house is paid to keep you playing? The solution is to become a bad customer. In the eyes of a PFOF-driven brokerage, the perfect investor is a disciplined, boring one. To do this, you have to break the relationship between your phone and your portfolio. Start by recognizing that the free aspect of the trade is a distraction. You should treat every trade as if it still cost you $20 in commissions. If you had to pay $20 to buy a stock, would you still do it? If the answer is no, then you are likely just reacting to a nudge or a temporary spike in emotion. The goal is to move from being an active trader to a passive owner. You want to minimize the number of times you trigger that order flow. This means choosing broad, diversified assets that you can hold for years rather than days. By reducing your trade frequency, you are essentially cutting off the brokerage's ability to monetize your mistakes. You are taking the power back by refusing to provide the volume they need to satisfy their market maker partners. Success in this environment is measured by how little you actually use the features they spent millions of dollars designing. If you think the hidden cost of the bid-ask spread is bad, wait until you see what happens when the IRS gets involved. We have been talking about fractions of a penny, but the tax code deals in whole percentages, and for the frequent trader, those percentages can be devastating. Most people do not realize that every time they swipe up to take a quick profit, they are signing a contract with the government that can eat up to 37% of their gains. But before we get into the tax bomb, we need to talk about why you cannot seem to stop swiping in the first place. It is not a lack of willpower, it is a direct assault on your brain's reward system. The engineers in Silicon Valley have found a way to turn the stock market into a slot machine, and they have placed it right in your pocket. If you have ever wondered why you feel a rush when the screen turns green, or a pit in your stomach when it turns red, it is because you are being conditioned. Let us look at the neuroscience of the dopamine loop. There is a common belief that we are rational actors when it comes to our money. We like to think we are looking at charts, reading balance sheets, and making cold, calculated decisions. But neuroscience tells a different story. Our brains are not evolved for modern financial markets. They are evolved for survival and immediate rewards. The designers of trading apps know this better than anyone. They use something called the hook model to create habit-forming products. It starts with a trigger. Usually a notification on your phone telling you a stock is up 5% or that a new cryptocurrency is trending. This creates a sense of urgency and FOMO, or fear of missing out. The action is the trade itself, which has been made as frictionless as possible. You do not have to call a broker or navigate a complex terminal, you just swipe. But the real magic, or the real danger, happens at the next stage, the variable reward. In psychology, a variable reward is something that happens inconsistently. It is the same principle that makes slot machines so addictive. You do not know if you are going to win or lose when you open the app, and that uncertainty is exactly what causes your brain to release a flood of dopamine. You are not addicted to making money, you are addicted to the anticipation of seeing what happens next. The math of dopamine is surprisingly consistent. When you receive a reward that is better than expected, your dopamine levels spike. This reinforces the behavior that led to the reward. If you make a quick $100 on a meme stock, your brain records that as a massive win, even if the underlying logic was flawed. Here is the problem. Dopamine is not about pleasure. It is about craving. It drives you to repeat the action over and over again, searching for that next hit. On a trading app, this translates to frequent checking. The average Robinhood user checks the app multiple times a day, far more than someone using a traditional brokerage like Vanguard or Fidelity. Each check is a pull of the lever. The math shows that the more you check your portfolio, the more likely you are to see a loss, simply due to daily volatility. Because humans suffer from loss aversion, meaning the pain of losing is twice as strong as the joy of winning, these frequent checks lead to emotional stress. This stress then triggers impulsive decisions, like selling at the bottom of a temporary dip just to make the red color on the screen go away. Over time, these impulsive, dopamine-driven actions compound into significant underperformance. You are essentially paying a psychological tax that eventually manifests as a literal financial loss in your brokerage account balance. Let us talk about the UI specifically. Why is the green so bright and the red so alarming? In the world of casino design, color is used to influence behavior. High-contrast, neon colors are designed to keep you alert and energized. When your portfolio is up, the app bathes you in a euphoric, celebratory green. This is a visual high five, telling you that you are a genius and you should do it again. When it is down, the red is not just a data point, it is a digital siren. It triggers the amygdala, the part of your brain responsible for the fight or flight response. When you are in a state of fight or flight, your prefrontal cortex, the logical, long-term planning part of your brain, essentially goes offline. You are no longer an investor, you are a panicked animal trying to escape a threat. This is why people sell their long-term holdings during a market correction. The app's design makes the temporary market noise feel like a life-threatening emergency. They also used to shower the screen in virtual confetti for your first trade. While they removed the confetti after regulatory pressure, they replaced it with other subtle animations that serve the same purpose. They are celebrating the act of spending your money, regardless of whether that spend was a good idea or not. They are gamifying your financial future for their own quarterly earnings. How do we fix this? The protocol is about reintroducing friction into your life. The app wants to be fast, so you need to make it slow. Step 1 is to disable every single push notification from your brokerage. You should never be summoned to your portfolio by an algorithm. You should only check your investments on a schedule you decide, perhaps once a quarter or once a month. Step 2 is to move the app off your home screen. Hide it in a folder on the last page of your phone. By adding just 2 or 3 extra clicks to reach the app, you give your logical brain a chance to catch up with your impulsive urges. Even better, delete the app entirely and only check your accounts on a desktop computer. The physical act of sitting down at a desk and logging in changes your mindset from casual gaming to financial management. Finally, you have to embrace the idea that if your investing is exciting, you are probably doing it wrong. Real wealth building is incredibly boring. It is watching grass grow or paint dry. If you find yourself checking your phone at a dinner table or while waiting in line, you are not investing. You are looking for a hit of dopamine. Recognize the craving for what it is and choose to do nothing. In this game, the person who moves the least usually wins the most. Most people think the biggest risk in the market is losing their money. They are wrong. The biggest risk is the opportunity cost of being a player instead of a builder. While you are chasing a 5% gain on a Tuesday, you are missing out on the massive, quiet compounding of the entire global economy. This is where most people stop. They learn about the fees and the psychology, but they fail to fix the leak. If you want to go deeper into the specific strategies I use to stay disciplined, I want to invite you to join the Optimizers. It is our channel membership where we get into the nitty-gritty of portfolio construction and market history. Clicking the Join button helps support this channel's mission to keep finance honest, and you will get a custom badge and priority in the comments. It is the best way to surround yourself with people who are focused on the math rather than the noise. But before we wrap up, we have to talk about the silent killer that catches almost every frequent trader by surprise: the taxman. If you thought the brokerage taking a few cents was bad, wait until you see the IRS bill for your day trading habit. There is a dangerous myth among new traders that if they make $1,000 and lose $1,000, they have broken even. On paper, their bank balance is the same, so they think they owe nothing. This is one of the most expensive mistakes you can make. The tax code is not a mirror. It does not always reflect your net profit in the way you expect. The IRS differentiates between long-term and short-term capital gains, and the gap between them is a literal fortune. If you hold an asset for 366 days, you are taxed at the long-term rate, which for many people is 15%. If you sell it even one day before that year mark, it is taxed as ordinary income. For a successful professional, that could mean paying 32 or 35% on every dollar they made. When you are trading in and out of positions on an app, you are almost always generating short-term gains. This means you have to be significantly better than a buy and hold investor just to reach the same after-tax result. You are running a race with a 20-pound weight on your back, and the app's swipe to trade feature makes it all too easy to keep adding weight without realizing it. You are not just fighting the market, you are fighting a tax code that was written to reward patience and punish activity. Then there is the trap that ruins lives every April: the wash sale rule. This is section 1091 of the tax code, and it is the frequent trader's worst nightmare. The rule says that if you sell a stock at a loss and buy it back within 30 days, you cannot claim that loss for tax purposes. Let us look at the math of how this destroys a retail account. Imagine you trade the same popular tech stock all year. You make $50,000 in profit on some trades, but you lose $50,000 on others by panic selling and buying back in. In your mind, you made $0. But if those losses were triggered as wash sales, the IRS says you cannot use them to offset your gains. Suddenly, you are being taxed on $50,000 of income that you do not actually have. If you are in a 25% tax bracket, you now owe the IRS $12,500 in cash, even though your trading account is at zero. This is not a hypothetical scenario. It happens to thousands of people every year who get caught up in the gamified cycle of trading meme stocks. The app does not warn you when you are about to trigger a wash sale. It does not show you a running tally of your tax liability. It just shows you the confetti and the green screen while a tax bomb is quietly ticking in the background. By the time you get your 1099-B in February, the damage is already done. Why do we fall for this? Because our brains are terrible at accounting for delayed consequences. A tax bill that arrives 12 months from now feels less real than the dopamine hit of a trade today. The brokerage exploits this temporal discounting. They make the buy feel like a win today, while the tax is a problem for future you. We also have a psychological bias called mental accounting. We treat our trading money as different from our rent money or tax money. But the IRS does not care which pocket the money came from. To them, a dollar is a dollar. The frequent trader often feels like they are playing with house money once they have a few wins, which leads to even riskier behaviour and more frequent trades, which in turn creates more wash sales and more short-term liabilities. The gamification of the UI reinforces this by making the whole experience feel like a closed system, a game with its own rules. But the rules of the game are actually set by the Internal Revenue Code, and they are designed to favour the person who does nothing. The tax code is the ultimate proof that the government wants you to be an investor, not a speculator. It is a system of incentives that we ignore at our own peril. The protocol for beating the tax trap is simple, but requires immense discipline. First, prioritise tax-advantaged accounts like a Roth IRA or a 401k. Inside these accounts, the wash sale rule and short-term capital gains tax do not exist. You can move money around without a tax penalty. Robinhood and other apps eventually added IRAs, but their primary marketing is still focused on the taxable brokerage account, because that is where the most churn happens. Second, adopt a buy and hold mindset for any taxable account. If you cannot commit to holding an asset for at least a year and a day, do not buy it. This single rule will eliminate 90% of your impulsive trades and guarantee you the lower tax rate. Finally, if you absolutely must trade for excitement, keep a play money account that is capped at 5% of your net worth. Treat this money as an entertainment expense, like a trip to the movies. If it goes to zero, it should not change your life. For the other 95%, use a boring brokerage and buy broad index funds. You will pay less in taxes, less in spreads, and you will spend far less time worrying about your phone. You win by refusing to play the high-frequency game and instead choosing the slow-frequency game where the math is finally on your side. We have covered a lot of ground today, from the hidden plumbing of payment for order flow to the neuroscience of the dopamine loop and the catastrophic reality of the wash sale rule. The common thread is clear. The systems we use to invest are often designed to maximize their profit, not yours. The narrative of democratizing finance is a powerful one, but we must be careful not to mistake access for success. Having the ability to trade for free is not the same thing as having a plan to build wealth. True financial literacy is about seeing through the confetti and the neon colors. It is about understanding that the house always wins when the players are active, and the only way to beat the house is to stop being a player and start being an owner. Wealth is built in the quiet moments of doing nothing. It is built by the person who can go a week without checking their portfolio and a year without selling a share. I want to hear from you in the comments. Have you ever been caught in a wash sale trap? Or did you notice your trading frequency spike when you moved to a mobile-first app? This community is about peer review and sharing the data so we can all get better. If this deep dive helped you see the math clearly, share it with someone who might be swiping their way into a tax bill. I am Tom, and this is Tom Talks Money. Thanks for your time.